Welcome back, everyone. Today, we're taking a deep dive into the life and career of Bill Gross, the Bond King. We're going to uncover some really valuable investing lessons from his journey, uh, his incredible successes, and also his bold moves and even his ultimate downfall.
Yeah, it really is a fascinating case study.
Yes.
It's not just about bonds, right?
Right.
It's about risk management, market psychology, understanding how to find those opportunities that other people just completely miss.
Absolutely.
So much to unpack there.
Yeah. Let's start with something that honestly might surprise some people.
Okay.
Gross had this early fascination with gambling,
Oh, interesting.
particularly his time in Vegas,
Hmm.
where he was using a card counting system. Now, this might seem like a world away from investing, but there's connection.
Yeah, I see where you're going with
Or
this.
do you see?
Well, his Vegas experience, it highlights the importance of things like discipline, calculated risk, sticking to a system even when things feel really uncertain.
Oh, absolutely.
And, these principles, they're just essential for investors.
You have to have a system.
Yeah,
You have to know when to walk away.
you do.
You have to know when to double down.
Absolutely.
And it's interesting how that mindset carried over into his professional life.
Yeah.
He essentially revolutionized bond trading at PIMCO
Hmm.
back when bonds were considered like the sleepy corner of the market.
Oh, yeah. Boring bomb.
Right.
Like,
Nobody cared.
nobody wanted to touch them.
And he saw an opportunity where others didn't. He recognized that bonds could be actively traded for profit.
Yeah, and that's a crucial lesson for any investor. Sometimes the most lucrative opportunities, they're hidden in plain sight.
I completely agree.
Yeah.
And he didn't stop there. PIMCO, under his leadership, famously predicted the housing crisis, and they profited from it. They saw the warning signs, what they called the Minsky moment, a concept that describes how periods of stability can lead to excessive risk-taking.
Yeah, and it's important to kind of explain what a Minsky moment is. Hyman Minsky, who was an economist, he argued that, prolonged periods of economic stability can actually breed this, like, complacency, and that leads to a buildup of debt and speculation. And eventually, that unstable structure, it just collapses, resulting in a crisis.
So PIMCO, they saw this Minsky moment unfolding in the housing market.
Yeah.
They recognized that this rapid rise in housing prices, fueled by easy credit and complex financial instruments, it was unsustainable. And they were willing to go against the grain, bet against that prevailing wisdom, and that, honestly, that took a lot of courage.
It really did. And, it's fascinating how they approached their research. They actually sent their mortgage team on trips across the country
Oh, wow.
to visit housing developments. They wanted to see firsthand what was the level of speculation, what was the potential risk.
It sounds almost like investigative journalism, doesn't it?
It really does.
They were digging deep, going beyond that surface level data to understand the kind of underlying dynamics of the market.
Exactly. And, this highlights the importance of independent research, having a framework for assessing risk, even if it means, challenging conventional thinking. And, PIMCO, they identified the shadow banking system, this network of financial institutions operating outside of traditional regulations as a major risk factor.
Let's explain shadow banking system a bit more for our listeners.
Okay, sure.
Essentially, it involved institutions that were lending and borrowing money in ways that weren't subject to the same level of oversight as traditional banks. And this lack of transparency, well, it made it difficult to assess the true level of risk in the system.
Exactly, yeah. And PIMCO, they recognize that this interconnected web of financial instruments, things like mortgage-backed securities, they saw that it was just a recipe for disaster.
And so they built up their cash reserves.
Right.
And they avoided those risky assets, which allowed them to capitalize on the downturn when it arrived. It's a really powerful example of how understanding market cycles and not blindly following the crowd can be incredibly rewarding.
Yeah, it's a great example of that.
Absolutely.
Yeah. So, PIMCO's success with the housing crisis, it really did solidify Gross's reputation as a brilliant investor.
Oh, yeah. He was the bond king.
Yeah, but his personality, his leadership style, which were already, intense,
Intense.
they seem to become even more pronounced after this.
Yeah, he was known for being demanding,
Oh, yeah.
eccentric,
Uh-huh,
and sometimes just abrasive.
for sure.
There are stories about his kind of unconventional behavior in the office and his, relentless pursuit of performance.
Yeah. And, while that kind of intensity might have worked in the early days of PIMCO, as the firm grew, it started to create some real friction.
Yeah.
Internal conflicts and power struggles, they began to emerge.
It's almost a classic tale of hubris, right?
Yeah.
As his success grew, so did his ego. And this eventually led to these, tensions with colleagues and ultimately, I think, contributed to his downfall.
Yeah, his story reminds us that even brilliant minds, they can be hindered by ego and just like a lack of self-awareness.
Yeah, and, building and managing a successful team, it requires more than just investment acumen.
Exactly.
It also requires strong leadership skills, the ability to collaborate effectively, and a healthy dose of humility.
Yeah, couldn't agree more.
Let's talk about the odd lot ETF strategy that Gross employed.
Okay.
It generated outperformance, but it also attracted scrutiny from the SEC. It
Right.
was a complicated strategy. Can you break it down for our listener?
Sure. So basically, the strategy involved kind of exploiting pricing inefficiencies in bond ETFs by trading in odd lots, which are share amounts that aren't multiples of 100. So by understanding how these ETFs were structured and priced, Gross was able to find these opportunities to, buy low, sell high, even when the underlying bond prices were relatively stable.
So he was finding these tiny discrepancies in the market and using them to his advantage.
Exactly. And while the strategy was technically legal, it pushed the boundaries of what was considered ethical. And, the SEC investigation, although it didn't result in any charges, it raised concerns about whether PIMCO was, using its knowledge and resources to unfairly benefit at the expense of other investors.
Right. And this brings up a really important point about ethics in investing, right?
Yeah.
Even if a strategy is legal, there's that gray area where it can become ethically questionable.
Absolutely. And, for professional investors, especially those managing other people's money, maintaining a reputation for integrity and fairness is paramount.
Okay, let's move on to the culture at PIMCO and Gross's eventual departure. It was a dramatic and messy exit.
It really was.
What can we learn from this episode?
Well, it's a classic case of how a toxic culture, even at a highly successful firm, can lead to instability and decline. The internal conflicts, the power struggles, and Gross's increasingly abrasive leadership style, it created this perfect storm that eventually led to his ouster.
It's almost Shakespearean, this brilliant mind who built an empire only to be undone by his own flaws and the crumbling foundation he had created.
Yeah, it's a powerful story, and it highlights the importance of organizational culture and, succession planning.
Yeah.
Even for the most talented individuals, long-term success requires building a sustainable organization, with a strong culture, a clear plan for the future.
And Gross seemed resistant to putting a succession plan in place. Perhaps he believed he was irreplaceable.
Yeah, and that lack of foresight, it created uncertainty,
Yeah.
and, it ultimately contributed to the chaos surrounding his departure.
It's a reminder that no matter how successful you are, no one is indispensable.
Right.
Planning for the future of your company, even without you at the helm, it's essential.
And, it's not just about the company, it's also about personal growth and recognizing when it's time to step back.
Right.
There's a lesson here about the importance of humility, of knowing when to let go, and, recognizing that sometimes walking away can be the smartest move.
Absolutely.
Yeah.
So even after this dramatic exit from PIMCO, Bill Gross's story continues.
It does.
He went on to join Janus Henderson,
Right.
but never quite regained the level of success that he had achieved earlier in his career.
Yeah. And, his time at Janus kind of highlighted this fact that past performance is not necessarily indicative of future results. The investment landscape was changing, new strategies were emerging, and Gross, for all his brilliance, he seemed to struggle to adapt.
It's interesting how his personal life seemed to kind of intersect with his professional life during this period. He went through a very public divorce and faced some legal battles.
Yeah.
And those events, they couldn't have been easy to navigate while also trying to manage a portfolio.
Right, and his experience really underscores the importance of separating personal emotions from investment decisions. Investing requires a clear mind, a rational approach. When those personal issues start to interfere with your judgment, it can lead to really costly mistakes.
It's a good reminder that even the most successful investors, they're human.
They are.
They have emotions, they make mistakes, and their personal lives can impact their professional decisions.
Yeah.
Gross's later years also highlight the importance of knowing when to step back,
Yeah.
recognizing when it's time to change course, or even just walk away. He seemed to kind of struggle with this, almost as if he couldn't let go of this need to prove himself.
Right.
There's a valuable lesson there for all of us.
Yeah.
Success isn't just about reaching the top. It's also about knowing when to move on to that next chapter, whether that means changing your investment strategy, transitioning to a new role, or even just retiring altogether.
And his story is a reminder that true success isn't just about financial gain. It's also about finding fulfillment and meaning in your life. It's about achieving that balance between your professional ambitions and, your personal well-being.
Bill Gross's journey is, a fascinating and complex one. It's a story of remarkable achievements, bold decisions, and ultimately a cautionary tale about the pitfalls of ego and the importance of adaptability. What are some key takeaways for our listeners, for those investment enthusiasts out there?
Well, I think we can learn a lot from his innovative strategies. His willingness to challenge conventional thinking, his ability to identify those opportunities that others miss.
Oh, absolutely.
But we can also learn from his mistakes, the importance of managing emotions, the need for humility, and just the recognition that even the most brilliant minds can be flawed.
His story also highlights the importance of building a strong team, fostering a positive culture, planning for the future. Even if you're a solo investor, these principles apply to how you manage your own portfolio and your own financial well-being.
Investing is a journey, not a destination.
Very well said.
It requires continuous learning, adaptation, and self-reflection.
Bill Gross, the bond king, he left an indelible mark on the world of finance. His story is full of valuable lessons, both positive and cautionary, for anyone seeking to navigate the complexities of the market and achieve lasting success.
That's right.
Thanks for joining us for this deep dive.
Yeah, thanks for having me.
We'll see you next time.